Hello everyone and welcome to a very unique webinar. Unique because the keynote speaker for today's webinar, it's not going to be me, but it will be Robert Pardo, who will be interviewed by my colleague Cornell. And Robert Pardo is, without exaggeration, a true legend. He was at the birth of automated trading globally some 30 years ago. So he has an incredible amount of experience and has developed dozens of strategies. He has revolutionized the approach to algo trading worldwide. He came up with a lot of methods for analyzing and testing robustness that we use to this day and that we work with ourselves in that advanced course. And I can say with absolute confidence that it's definitely worth your time to watch this interview with such a legend. And when we look at Robert's experiences, as I mentioned, he was at the birth of automated trading in the 1980s, which is a very long time indeed. He's had very superior results over the long term, so he's really thrived over those few decades. And Robert Pardo is a great example of how automated strategies really work over the long term. He's also the author of the walk forward analysis method. That's the method we use to test robustness, but we don't use it in Strategy Lab. We use it in more advanced course because it has its undeniable advantages. Robert is the author of legendary books about automated trading, and in his talk today, he's going to focus on robustness testing, the sustainability of automated strategies, and he is also going to talk about recommendations for beginning traders that I hope and I really do believe a lot of you will find useful. And additionally, Robert is one of our clients. We are preparing a special version of StrategyQuant for him to better fit his style of strategy development. And even within his talk, he mentions that StrategyQuant is a great piece of work. And we are honestly very happy that an icon like Robert has given a positive response to our software that we've been working on for over a decade. I mean, it's really great. I mean, what you want more? Besides that, the world universities are using our software. Such a nice words from such a legend as Robert Pardo. It's really something very nice. But now let's get right into it. So take your time, make yourself comfortable, and enjoy the interview with Robert Pardo.
Hi, I'm Bob Pardo, and I'm speaking to you from the Chicago suburbs in the United States. I'd like to thank the folks at StrategyQuant for the opportunity to talk with you folks today. And I, as some of you may know, I'm considered to be an expert in strategy development, and I'm going to give you some of the main guidelines that I use in building strategies and give you some ideas of why they're important. But before we do that, I'd like to give you a little bit of my background so you understand that I do know what I'm talking about, and in fact, I walk the walk. I don't just talk about this. So again, I'm really talking about the importance of robustness in strategy development. And I started out doing this in the early '80s as a software developer. I was one of the very first people to actually build trading strategies that actually worked with a microcomputer for the individual investor. That evolved into me doing consulting for a lot of large trading firms. Along the way, I wrote a book. The original one was called "The Design and Testing of Trading Strategies." I updated it in 2008, and also I am the creator of walk forward analysis, and we use walk forward analysis to actually develop all the strategies we've ever used, and we use walk forward analysis to actually develop the strategies we're using now in our new program. So anyway, I started with the Pardo Corporation in 1980, and we built a lot of different trading programs. One of the most famous ones probably not known now, but one of the first programs to actually let people actually build and trade trading strategies was a program called Swing Trader. We created something called the Chartist, the Advanced Chartist, and the Advanced Trader, which was very much like it was a Windows it had a window menuing, but before Windows existed, and it was a program that allowed people to actually do sophisticated graphic analysis as well as develop and test trading strategies in a fashion very, very similar to what TradeStation is now. We also had another family of products called Blast, and there were about a dozen applications in there, which were non-graphical but highly powerful, highly automatable strategy testing and development environments. And in those, we actually had we built walk forward analysis into all of them, and actually we did a walk forward analysis in a way that was more sophisticated than actually anybody is even doing it now. But that's another story. In any case, in some of those strategies, actually, we wound up creating an application called XT, which was actually it was a strategy development platform plus a whole portfolio of strategies, which we leased in those days for $25,000. And we, in the process of doing all this, I was approached by Goldman Sachs to create a customized version of Advanced Trader. That project lasted for quite some time, and we actually built them a real-time version of Advanced Trader, which actually ran in OS2, which it came and went very quickly, but it was a very good operating system. And after that project ended, I did a joint venture with Daiwa Securities of America. I had a client, the person who headed their U.S. operation was a customer of mine on the software side, and I approached him about building a multi-strategy money management program. And that project ended. They actually gave me the rights to all of the strategies that we developed, and one of those strategies actually became XT99 Diversified, which was a program we ran with Dunn Capital Management. They were a pioneer in algorithmic trading they started back in the late 80s, and I started working with them in 98. And we ran XT99 Diversified for about 12 years, and it produced real-time returns of about 19% a year annualized rate of return, with our best year actually being 142% in 2008. Interesting to note, by the way, that is one of the, certainly, I, as the creator of walk forward analysis, of course, I'm a big advocate of it as well, but it's interesting to note that the strategy that became XT99 Diversified that ran for 12 years with Dunn actually was built in 1993 with walk forward analysis. And the only thing that was ever changed about it was the way in which we did the walk forward analysis going forward. I originally built what became XT99 to be a faster program. Dunn wanted it to be a slower program because they trade very big size. And especially in those days before the electronic order entry, it was more difficult to trade fast. What would be considered fast now, but fast in those days, which was every day or every couple of days. It was hard to do it with a lot of money, so they slowed it down a little bit. And we actually ran a slower walk forward as opposed to the fast one that I originally developed it with, but nothing else ever changed. We never modified the strategy from 1999 to 2012 when we stopped running it, other than to update the parameters. XT99 also was cited over 35 times for top trading performance in various categories, largely by Barclay Hedge. I was also fortunate enough to actually be featured as one of the top traders in 2008 in Futures magazine. This is the latest version of my book. The first one was written in 1991. And back in those days, it was referred to as the Black Bible. Not to sound heretical, but that's what a lot of people called it. And that in that book, I really mapped out what is now considered to be common practice in optimization, although a lot of people still don't actually do it to the same degree of thoroughness that I mapped out in my book. And even though I had published an article about walk forward analysis prior to this, I really explained walk forward analysis in the most detailed presentation that's yet been published in that book. And then I did it again. I didn't really change it very much for 2007 because it didn't really need any change, at least in my opinion. So, the thing is, I developed, walk forward analysis really is a sophisticated application of out-of-sample testing, as some of you may know. It's now considered the gold standard for optimization. And even though some people in machine learning they prefer what they prefer another method, it really is, if it's done properly, it's as thorough as cross-validation, and in many cases, probably more thorough. But I actually developed it out of pragmatic necessity. I had really found that when we were building the strategies with our software in those days, I don't know how far back many of you know about microcomputers and so forth, but in those days, if you had a 1 megabyte of memory, you had a lot. And as you might imagine, it was very difficult to get it to load a lot of data. So one of the things one of the ways we compensated for not being able to load 10 years, which you couldn't do in those days, at least not in any way that's rapid. And we actually found that by looking at a smaller window and periodically re-optimizing it, we were able to actually do very nicely. So we essentially realized, well, we were originally kind of doing it a little bit by hand, as some of my customers were, and we realized, well, that's something the computer can be taught to do. So we did, and I've never looked back, because at this point in time, I'm going to jump ahead a little bit in the story, but at this point in time, I've probably run at this point in time literally hundreds of thousands, if not millions, of different optimizations with our computers. And I've never had any reason to not use walk forward analysis. I've had a lot of reasons not to use just simply a straight optimization, because it's very unreliable. But walk forward analysis has proven itself again and again to produce strategies that perform in real time like they perform in testing. So let's see. So anyway, that's a quick thumbnail sketch of my background. I started doing this business back in 2015. I released a program called Ranger in 2018. We released Ranger Alpha, which are strategies that run on 60-minute E-mini, the E-mini, and have produced over almost close to 300% return since their release. And that's actually on relatively conservative leverage. And we're also, I'm very pleased to be able to say we're going to be releasing a Ranger version for SQX sometime in July or August of this year. So, one of the reasons why I wanted to kind of show you the diversity of my background, software development and consulting to top trading firms and trader, is I want you to realize that coming up with something like walk forward analysis and developing the confidence that I have in it is based upon years of experience and upon the fact that, when you're a money manager, you only get paid if you perform. So, we built XT99 Diversified, as I mentioned, with it, and was maintained with walk forward analysis throughout its life. Ranger Alpha was created and is maintained with walk forward analysis. We built a program called Pardo Renaissance Diversified, which was a highly strategy diversified platform. That too was built entirely with walk forward analysis and maintained accordingly. and that performed extremely well. That performed extremely well also. So essentially, the point of all this is that this is actually this is really kind of like, this is the proof of these different laws that I believe are crucial to building robust trading strategies. Now, this is something that I think a lot of people would be surprised to hear, but let's start out what I'm going to say about this, and then why I say it. And that is that a strategy that is not proven to be robust is worthless, no matter how great the optimization looks. This really we could go into a lot of detail about this, but the bottom line here is that as I said, I've been involved with hundreds of thousands of optimizations and walk forward analyses. And I even occasionally, when I'm building a new strategy, I don't put it through walk forward analysis until I know that it actually has some merit. But having seen many of these things, I can tell you that the only optimization that you really can count on is a comprehensive optimization that actually has nothing but winners. If you have a strategy that looks like that when you optimize it, then you don't need to really do anything else. However, even if we routinely, when we were developing stuff with Ranger, we routinely have optimizations that have well more than half, if not 2/3 of the results being being worthwhile in optimization. But I still insist on putting it through. I still insist on putting it through the full range of our robust testing, because without that, I just don't have any confidence in it without having done that. You could really, because I know I've talked to other people involved with just doing optimization work for developing strategies, and I was told by a guy who actually was he was an asset allocator, and when I explained to him my process, he said, most people don't even do 1/100th of what it is you do. They just run an optimization. If some of the results of the optimization look good, they think they've got something, and they go with it, and then they're surprised when it fails. So I can honestly say that if you haven't done, no matter how good the optimization looks, if you really haven't done robust testing, it can be nothing more than a very destructive and dangerous fantasy. And it's dangerous because if you're going to put money on it, you're very likely, the chances of losing money are very high. If it's not robust, you will lose money. So robustness, you say, what's robustness? Robustness in this context is a little different than what people think of a robust health, for example, although it's analogous to it. But in other words, robustness really is a term we use to decide whether or not a strategy will produce real-time trading results that are in line with its testing profile. One of the things we have found with walk-forward analysis is if you do it correctly, your real-time results will very closely model your test results. So this leads me to my second law. A strategy that has been proven statistically robust will produce real-time trading results that are very much in line with its historical test profile. In other words, what you see is what you're going to get. This is, I know a lot of people think that when you do an optimization, this is what's going to happen. You're going to do an optimization, and it's going to give you results just like what you've done in testing. There's a lot of ways you can fool yourself with optimization. One of the worst of which is optimizing lots and lots and lots of parameters in a strategy. And I don't know how many of you people have ever done any work with actual statistical modeling, but I learned the hard way years ago when I was first doing Fourier analysis to do cycle forecasting. When I first started fitting curves with Fourier analysis to these markets, the curve matching was ideal. I thought to myself, wow, this is amazing. This is going to be great. But what it really boils down to is if you don't do it right, all you're really doing is curve fitting, which is not the same thing as actually doing optimization or robustness testing. So this is the third law, and this is aside from the fact that you're actually going to have something you can have confidence that will actually perform in real time. A robust trading strategy will produce a highly accurate performance profile, which can be used to reliably quantify risk and reward. The value of this, of course, is that this performance profile can be reliably used to efficiently allocate capital. Without knowing your true risk, you really can't properly capitalize a trading account with, at least with knowledge. You can do it based on guesswork, you can do it based on the optimization results and so forth. But when you know your risk, you can quantify correctly. When you know your reward, you can compare it intelligently to other markets and to other strategies and see whether or not it really is worth putting any money on. So then, don't misunderstand me. I'm not dissing optimization. Optimization is the first step in a strategy validation. When we're doing our process, one of the first thing we do, of course, is run an optimization to see whether or not anything we've got in there is worth looking at any further. So this gives you some idea whether or not you actually have some positive expectancy. It also tells us whether or not the performance is big enough to either look further, because when we run through our process, sometimes we see results. I have an intuitive idea of what I expect from different markets, and if it's way below that threshold, even though it's profitable, it's not good enough. And also, one of the things it will also tell you is it'll give you a first look at the quality of it'll give you a first look or a crude look or an estimate as to the quality of robustness in a strategy. If you're looking at 1,000 combinations in an optimization and 10 of them are profitable, even if they're highly profitable, you really have a fantasy. If you're looking at the same number of optimizations and you've got 500 or 600 of them that are profitable and nicely so, the likelihood is fairly good that it will actually be robust. However, I can tell you that alone is that's not a sufficient guarantee. So anyway, then what's wrong with optimization? Well, like I said, nothing if it's understood and used correctly. Everything is wrong with optimization if you believe it's the final word in strategy development. And everything is wrong with it if you believe that it will tell you whether or not a strategy is robust. Like I said earlier, I've looked at thousands and thousands of optimizations, and I still no reason to trust the results of an optimization by itself without any further testing. So essentially, that's why I created walk forward analysis. We were having this experience way back when of doing optimization and having things not go very well going forward. So we actually we did what a lot of people did in real life, which is to walk it forward. And one of the most important things to recognize about walk forward analysis is that if you're looking at a walk forward analysis over a 10-year time period, it's important to understand that if it's a walk forward analysis, you're only seeing out of sample trading results. You're not seeing any in sample trading results. And one of the things we've also found is, one reason why some people diss walk forward testing because they think a walk forward test is simply one optimization and one out of sample test. Well, that is one walk forward, and I can tell you from based on experience that one walk forward can be as big a fluke as an optimization. That's why it's important to do as many walk forwards as possible in your data. And one of the things we have done as time has gone on is we've gone down to faster time frames and to longer walk forward analyses where we don't just have 3 or 4 or 5 or maybe even. I personally feel if you have fewer than 10 forwards in a walk forward analysis, it can be suspicious. It's possible, but it's way better to have a walk forward analysis that has 20 or 30 or even more walk forwards in it. So the solution really, I would tell anybody who wants to get involved with trading algorithmically that you have to do a walk forward analysis or some kind of equivalent robustness testing. And I personally don't know if one is good as, if not better than walk forward analysis. But in any case, some of the solutions are, you can use Ranger. We use walk forward analysis to create strategies with it. Ranger Maker, which is an add-on for Ranger, actually automates much of the testing process. Walk forward analysis can be done very nicely and very rapidly in StrategyQuant X. Ranger SQX is going to use walk forward analysis to create strategies. And there's also going to be a version of Ranger SQX that will completely automate the strategy creation and validation with using walk forward analysis, so that it'll be done entirely from start to finish. You simply start it, and when you're done, you'll have a batch of strategies that'll have been validated with walk forward analysis. Okay, so if anybody wants to get in touch with me, this is how you do it. Best way to do it is to send me an email. I'm usually pretty prompt about answering them, but I am often really, email's best. Let's put it that way. Okay, so there were some questions. So number one, the optimization profile. Yes, I did create that back in, I created that back in, or actually our first software, and talked about it in my book. It really is nothing more than just a profile of the statistics that are key to performance. The idea is to actually figure out whether or not you, when you've actually had a problem with it, if you're having a drawdown, are you within the performance profile or not? So we look at things like the number of losing trades, the number of winning trades, the average runs, average trade size, average drawdown is we keep in mind the max drawdown, but what's more important is the average drawdown and also the duration, the average duration of the drawdown. So it's basically just what you want to know is that in real life you're performing in line with your profile. And one thing that's kind of important to note, that there's a little dynamic component to this, partially because if you're trading a strategy, and certainly we've seen this in markets like Bitcoin and markets like, and certainly the stock market, which has just been in a never-ending bull market, you basically, as a market goes up in value, the volatility changes. So if let's say your volatility actually doubled in a year from what it was in your test profile, you kind of expect, experience has shown that you generally expect that if volatility doubles, your risk and your reward may well double. So if your average drawdown, say, was $10,000, and that was based on volatility A, and then we're at volatility B, which is twice volatility A, it might not be a real surprise if your drawdowns go up to like $15,000 or $20,000. But in line with that, it's important to note that if your drawdown is going to go up, your performance also had better go up. If it doesn't, let's say, for example, this is how the profile would actually help you. If your drawdown volatility doubled, your drawdown went to double, but your performance halved, that's telling you something's wrong. Are there any other techniques besides walk forward analysis that can be used to test the strategy robustness? Well, I know that some people use other methods. The one that I have the greatest amount of respect for here at this point in time would be cross validation, which is very similar to doing a number of walk forwards. But I'm not aware of any, and I'm not. I mean, I personally am very confident in walk forward analysis. So I'm kind of the school that if it ain't broke, don't fix it. How long does a profitable strategy usually last? Well, I think I pointed out earlier in the presentation that, that the strategy we ran in XT99 was actually built in 1993. We started trading it in a version of it in 1999. Never changed. We never changed the strategy at all in all that time. We only changed the parameters, and we would do a little mixing of the basket, but that's a different story. And in fact, these same strategies are still working very nicely now. So, in general, I mean, so that how long is that? Is that like that's more than it's about 27, 28 years. So, I personally think that a profitable strategy.
Question to this one.
I'm sorry.
Yeah, if may I have additional question to this one?
Sure. Sure.
Yeah, because many people say that markets are changing and there are like new like Bitcoin and other assets that life period of strategies are shorter and you need to adapt them more often. Do you see it from your point of view, from experience, or rather you simply once you develop very robust strategy, then it can last for years?
I think ultimately, yes, markets do change, volatility changes, trends change. The simple truth is one of the other great benefits of walk forward analysis, and one of the things that we didn't talk about, is that walk forward analysis, and probably one of its best benefits, it's adaptive. So your parameters will change in response to changes in regime, in response to changes in trend, in response to changes in volatility. That's one of the great big advantages of it. So I mean, we have part of the thing is, I've been an advocate of having multiple strategies, and we are fortunate to have. Well, we're fortunate to have hundreds of strategies that are profitable. So one of the things that's a great opportunity. That's one of the reasons why I'm a big advocate of something like Ranger and SQX, is that I think it's a wise idea to have as many strategies as you possibly can have, because even if a strategy is profitable, it can have a drawdown when some other strategy is doing extremely well. So there's not a really, I don't think you really can say there's a hard and fast rule about this, but I think if somebody tells you that a strategy is going to last you for 2 or 3 years, then you have to throw it away. I think you really haven't built a very good strategy. That would be my take on the whole thing.
Thank you.
Does that answer your question?
Yeah, it was perfect. Thank you.
Sure. Well, this is how often you recommend reoptimizations of the strategy parameters. Well, that's about as easy as it can possibly be. That's dictated by the walk forward analysis. So all of our stuff has a calendar when you have to reoptimize it, and you just simply go by the walk forward analysis you've chosen. I mean, I don't think you can say. I mean, I know in truth, with XT99, because Dunn thought it was an interesting idea, we would do the reoptimizations once a year. So we actually wound up doing essentially a 10 by 1 walk, a 10 year by 1 year walk forward analysis. And so I think, I don't think, I mean, I know that in fact people have done, they have the bad habit of when they get into a drawdown, they don't like having the drawdown, because who does? But the simple truth is they're going to have the best will have drawdowns. The question is, how deep, how long, and is it in line? But some people just kind of say, okay, well, I'm having a drawdown. It doesn't work anymore. Let's just throw it away. And then guess what? It starts to perform nicely again. Or they just kind of arbitrarily do an re-optimization when they don't like the way it's performing. We're very religious about this. We do just what the walk forward analysis dictates. So if it's a 6 month by 2 month window, that's what we do. Every 2 months we do it. Now, one of the things that we don't do is I learned a long time ago, you really don't want to walk forward analysis to work on calendars. So for example, you don't want all your strategies and all your markets to be running, let's say, for example, a 12 month by 3 month happening on the same day in the same month. There's you wind up building into it the calendar bias, because there are cycles and there are calendar cycles. So I like to have optimization. We like to have our walk forwards. A lot of them start like the next window will start like June 23rd, and we have to re-optimize it, and then the next optimization is going to be sometime in August 7th or something like that. I think it's very good not to have it on the calendar. I think you have to really be strict about it, and just do your re-optimization based on the walk forward analysis. If you don't do a walk forward analysis, then I can't tell you. I can't help you here. Well, what is the main sign that a strategy has stopped working and not just going through a regular drawdown? Well, this is actually, again, this is actually like we talked about with the optimization profile, and looking at the average drawdown. The only thing you really can do is trust the numbers. So if you're basically in line with the key metrics, average trade, and by the way, not just a fixed number, but the average trade plus or minus like 1 standard deviation, the average drawdown plus or minus 1 standard deviation. Same thing with the runs and so forth. If you're having, like I said before, if you're having, let's say we go back to our example where the volatility is doubled, and we have a drawdown that's in proportion to the volatility increase based on our stat profile, but the performance has actually really shrunk. You have to look for anything, you have to look for any kind of sign that a strategy is basically misbehaving and the key performance metrics, and that's really the only way that you can do it. But one of the things that people I think don't really understand about this whole thing is that ultimately, if a market, any strategy is going to be basically beholden to the market. Like they say, a rising tide, all boats float in a rising tide. In the stock market, if a stock's not going up when the market's going up on the whole, obviously there's a problem with that stock. In the same kind of way, it's important to really understand that if your market is really moving very directionally, and you have a strategy that would benefit from a trend movement that's not performing, then there's likely something wrong with the strategy. Now it could have basically it could be having a problem, but you have to kind of look at whether or not are you doing badly because of the market or because of the strategy? And as I say, if the market's really moving dramatically in one direction and you're not making money, then there's probably something wrong.
Yeah, so basically, even if you have like big number of strategies in your portfolio, you still know in which market regime the strategy works best, I would say. Still know if the strategy, if it's trend following or mean reversion or other, and you are looking if it's in sync with the as market is behaving. So So beside the statistic, you also watch like the market behaving and watch if strategy works.
Yes, you have to. One of the things in our mix, we have kind of found that having, if you have 5 strategies in a market, we prefer to have 3 that are mean reverting or counter trend and 2 that are with trend. There are exceptions to that. When you have a very, very strong trend, the mean reverting things aren't going to be working as well. But it's important to understand the proper weather for your strategy. And if the weather is good for if it's weather appropriate for your strategy and it's not performing, then there's a problem. Make sense?
Yes, perfect. Thank you.
Based on my experience, what's the most important characteristic of an optimal portfolio? Well, I mean, I think the most important characteristic is that it's performing well with very low drawdown. When we put together a portfolio, we're always looking for the most diversified possible basket of strategies, and the most diversified basket of markets. So for example, a portfolio that trades all the energy futures would not be considered to be a particularly well diversified strategy, but a five market portfolio that trades a stock index, a currency, a metal, a grain, and an exotic like coffee or something, that has nice diversification. If you want to have 5 strategies for each market in your portfolio, we have that more. You don't really want to have 5 with trend strategies, unless somehow the with trend strategies are so different that they're really not terribly correlated. You really want to have, like in Ranger, for example, we routinely look for, we call it a trio. We want a with trend, a counter trend, and a trend neutral. And those are they're very different strategies from each other, and they'll have very low correlation to each. So the combination of those 3 will have a much lower drawdown than simply trading a 3 lot on one strategy, which will simply triple your draw. You'll simply have 3 times the drawdown and 3 times the performance. So the bottom line is performance and drawdown.
Yeah, thank you.
Has algorithmic trading over your career? Well, that's a funny question. It's funny. It's not the question's not funny. It's just ironic because when I first started doing this back in the 80s, you would not believe the arguments we would have. Let's call them debates. People had to be convinced that we call them trading systems then, that a trading system even had a chance of making any money. People did not believe that a trading system could actually produce profits. They only believe that what we call discretionary trading now could be profitable. So I think the first big, and now the irony I find is that in some worlds, people don't really believe that a discretionary trader can make any money, and they only believe that algos can make money. And the truth, of course, is in the middle of all that. So that's one big change has been that the world has really embraced wholeheartedly algorithmic trading, and that's been a very big change. And it's not a coincidence that it happened along with the rise of computing power. The other thing that, of course, has really changed is that most amateur traders don't do this, but the high-speed trading has really become a huge factor in trading. People largely. But I guess the good news is that even high-frequency trading, as they call it, really kind of comes more into the area of what we call market making. Guys used to make a market on the floor in the pits, and by holding really big inventory and being able to give people a trade on either side. But that's been taken over by a form of high frequency trading, which essentially is market making. And that market making really, it's really a different way of trading, and it has more to do with what they sometimes call market microstructure, and more to do with gaming the system than it actually has to do with actually trading. It also has to do with the fact that in Chicago, I think we have a lot of what we call proprietary trading firms. It's actually a formal method of organization that you have to practice. You have to follow the guidelines that the exchange has set up. But one really big advantage, of course, is that people who do proprietary trading, they all have memberships, so they don't pay any exchange fees. So their commissions can literally be a couple of cents, and sometimes now they're even giving people free commissions in some areas. So that's, and also with the prop trading firms, they are able to use leverage in ways that the average individual can't. So hedge funds who trade stocks all use leverage, because the hedge funds leverage stocks usually about 10-to-1, which is approximately similar to the leverage which is native to trading futures. However, with a prop trading firm, you can add leverage on top of that. So not only do you have the leverage of then it gets more like in Forex. Not only do you have the leverage of the 10-to-1, say in futures, but if you're leveraging it 4 times, then you're actually leveraging 40 times. You have 40 times on the asset value. So some of these things have really been the changes. But the simple truth is, people like to think that because of computers and high frequency trading and because of artificial intelligence and so forth, that the game has really changed and people can't really make any money anymore if they don't have all access to all these things. Well, that's just not true. So that's the good news. And I actually have a presentation about this. But the good news is that markets still will have trends. As long as you have trends, you can make money. So it's just a matter of actually figuring out what it is you're doing, and not trying to do something that actually is out of your reach. I mean, you're not going to compete with the high frequency traders. Spend tons and tons of money on really, really, really fast computers, and they spend a lot of money on their clearing costs and so forth. And you're not going to beat these guys unless you actually can outspend them and beat them at their own game. So you don't try. You have to do what still works for you. And ultimately, if you can't come up with a strategy that works within your risk guidelines, then I suppose you have to look to be doing something different. But ultimately, there have been a lot of changes, but the markets are still the markets. They still move. Some markets are hot, some markets are not. Those rules they're still in place, and the AI has still not gotten anywhere near what it will eventually become. And that's, of course, that'll be a different story when that actually comes into play. But I personally feel that, in the end, even though algo trading works extremely well, and it's been the way I've made all the money that I've made in the markets has been that way. A discretionary trader can still make money, but one of the things that you'll see more and more of is you'll be seeing more and more, let's just call it, for want of a better word right now, robotic artificial intelligence support of algo trading as well as of discretionary trading. And I think this is going to be, I honestly don't really believe that that's actually going to end opportunities for people, because it's going to make more opportunities. Because the simple truth is, with all of the electronic trading, what's really happened is you have deeper markets and you have more markets. And with as long as the world manages to hang together and continue to develop the way it is, we're going to have more and more markets to trade and more opportunities. And I think it's just going to be a very, very nice time for all of us if we play the game correctly.
Yes, it's thank you for the like very detailed answer. I think it's good news for all the traders, retail traders, that there is still place for them in market, and that they will not be moved away by those guys with like unlimited funds. And
don't let it be don't be discouraged by it, because I actually did an interview with Andrew Swanscott about the AI trading. It's AI and trading, and it's actually on YouTube. So if anybody's interested, they can go check on that as well.
Yes, in StrategyQuant we are trying like having balance, like using computer power, but still be able to put your ideas in it. And sure. I think when you find the balance and use the power to do the calculations and the optimizations, but you can set the process and you can put your idea in it, then I think you can win very well.
I agree.
Yeah.
You guys are doing a nice job with your stuff. It's very nice.
Thank you. Yeah, I think we can move to the last question.
Is there one more? Oh yeah. Oh, sorry. Yeah. Sorry. A long history of trading. Yeah, that's for sure. I think a lot of people think with trading that all you have to do is get a strategy that works and you're set. Trust me, that's not the way it works. I think I would say to anybody who really wants to make a living at trading, I think it's important for them to really understand exactly what's required to do that. Number one, and number two, I think it's very important that people have honesty with themselves. If they really can't put themselves in the seat of a trader and be comfortable with it, you probably are better off giving your money to somebody else to trade, because you're probably not going to do very well. All the traders that I know who have been successful are very honest with themselves, and they actually there are certain qualities that are important to being successful in trading. And even when you're doing discretionary trading, you have this idea that the computer is pulling the trigger. Well, that's true if you let it. I can't tell you the number of stories I've had of customers of mine who've had great strategies who just refuse to take the signals and find all kinds of ways to mess with their strategy and screw things up. So it's important to also know what it is you want from trading. A lot of people, I've seen when I used to be in brokerage many years ago, I saw a guy come in with $15,000 cash when that was more like $50,000. And he actually blew himself out in a matter of 2 days. So I mean, it's important to understand that trading is a business. It has challenges. It's gonna, in all likelihood, I don't know that anybody's ever going to go through trading for any length of time and not get whacked. I mean, I remember years ago when I was working, when we're running XT99. And the first Gulf War went hot. We were actually, in that month, we were up about 15%. That day it went hot, we lost 11%. And I know my son was looking at me when I was looking at the computer screen. He said, "Dad, are you okay?" And I said, "Yeah, I'm okay." Why? He said, "Because your face just went white. All the color drained from it." So it's going to happen. And if you can't live with you don't trade to be right. You don't trade for thrills. You don't trade to gamble. You trade to make money, and it's a business, and you have to run it like a business, and you have to be able to have the self-integrity to know you can run it like a business. And then, of course, the next most important thing is if you have that, that's the most important. That's, I think, maybe the most important thing, because if you have that, you can also apply that to building strategies. And the other equally important thing then is to make sure you have strategies that are robust, and then to make sure you have the strategies integrated into a portfolio that you can afford to trade, and a portfolio that will has enough money in it so you can withstand the drawdown and come back to keep on trading. And this is what I would say to anybody. It's a lot of people think it's a very tough business. Most people who enter it, like in most businesses, don't succeed at it. And if you can't be devastatingly honest with yourself, and if you can't be completely objective about your trading and about your strategies and so forth, you'll never make any money as a trader. So that would be my advice: honesty and robustness.
Thank you very much.
You're welcome.
For giving us your time and sharing your experience. I really appreciate it. And from my experience, many our customers from StrategyQuant are asking those questions, because it's always like their create strategy and then strategy has drawdown and they need to deal with it. So I think it will be really interesting for them to see all this problematic and this area from someone who has this long-term experience and go through the numerous those crises, drawdowns, everything, and finally survived and can give some truth and some advices. So again, thank you very much for your time.
My pleasure. I hope it helps.